Markets are at all-time highs, valuations are stretched, investor euphoria is at record levels, and yet there's one signal that always flashes before a full-blown market crash. Ignore it at your own risk. It's not just a chart or a data set. It's that feeling, the one where everyone suddenly thinks the market can only go up, where the fear of missing out becomes louder than the fear of losing money. Here's how it plays out. At first, everything looks perfect. Earnings are strong, economy is growing, unemployment is low, optimism rules, headlines rave, analysts upgrade stocks, retail investors pour in. It feels like this time is different. Then something subtle changes. The number of companies going public skyrockets, hype replaces fundamentals, stories matter more than profits, and stock tickers begin to look like a casino floor. That's when the always kicks in, when valuations detach from reality, when leverage grows, when everyone is convinced the only way is up. Let's look at some historic examples. In 1929, in 2000, in 2008, each time, before the crash, the ingredients were the same: peak speculation, peak confidence, peak complacency. When the big crash arrived, it seemed sudden, but the warning signs had been there. Today we have new forms of speculation: cryptocurrency hype, AI chasing sky-high valuations, private markets burning billions, and yet the same dynamic: euphoria. But here's the dangerous part: when we're in a bull market, everyone's busy celebrating. No one wants to hear about risk. No one wants to prepare for a fall. Because it's easier to believe this time really is different. So what can you do? First, check your exposure. If you're 100% in equities because it only goes up, ask yourself what happens if it doesn't. Second, focus on liquidity. When the crash comes, the biggest risk isn't just loss of value, it's the inability to act. Third, stay informed. Recognize the signs: new issue frenzy, record valuations, leverage spikes, consensus optimism. Fourth, protect what matters: savings, income, optionality, because you can build back wealth. You can't build back time lost. In short, the crash isn't inevitable, but the warning signs are always predictable. If you see them and act accordingly, you won't panic when everyone else does. You'll simply stay ready. Remember this: when everyone believes the market can only go up, that is when the market usually proves them wrong. Stay sharp, stay prepared, and don't let the always take you by surprise.
Thank you for watching Vectorlog, where we try to bring you the best financial advice you'll ever need. Don't forget to hit the like button, the bell icon, and the subscribe button, and stay tuned for our next videos.